Hi everyone, welcome back to the chapter 3. And in chapter 3, we are majorly talk about the balance sheet and how to disclose financial statements. Okay, so as we know, balance sheet is reporting a company's financial position at a point of time. What that means that all the accounts on the balance sheets are permanent, right? So in other words, uh, the situation and the financial position of the company that described in the balance sheet is only a snapshot, means that it's just as of one day, say January 25, as of today, what it looked like, right? Instead of income statement, it's like a story that is like a movie. It has a beginning and has ending, right? And the financial position is like as of that day. It's like a photo what this companies look like, right? And it provide and organize the list of the asset, liability, and equity, right? And a group according to the common characteristics. So let's look at the Nike's 2017's financial statements balance sheet. It has 23,259 total assets. It is organized in the current assets and the long-term assets, right? And then so therefore, we wanted to, and then if you wanted to see, there's a liability section and the shareholders equity section, and as we know, the golden equation is asset equals liability plus equity. So if you're adding $10,000, 10,852 total liability plus a shareholder equity of 12,407, if you add these two together, it has to equals the assets, right? Okay. Balance sheet, its usefulness is regarding to describe what is the position of the asset, how much is the asset, and what is composed of this company's asset, right? It provides a list of asset and a liability that are classified or grouped according to certain kind of characteristics, right? For example, grouping itself providing a very useful information about the common characteristic of certain elements, certain groups of assets. For example, it can be organized or categorized based on the liquidity, right? In the liquidity, its definition is the ability of a company to convert its cash to its asset to cash. Means how fast that your resources, right, or your assets can be converted to cash. And then also you can look at being categorized as used based on long-term solvency. And then the definition of it is means it refers to assessment of whether a company will be able to pay all its liability, including long-term liability, right? So solvency is used to describing the ability for company to converting asset to cash, and the solvency means that is its ability to pay all the liability, including long-term ones. And then so other things being equal, the risk that a company will not be able to pay its debts increases with the liabilities relative to equity, right? So this we're going to talk in details in this chapter. Solvency also provide information about the company's flexibility as well. And what is the flexibility? It means the ability of a company to alter cash flow in order to take advantage for unexpected investment opportunity and needs. In other words, if you have a solvency problem, right, that means a lot of your money or your cash is gonna be tied to pay for the debt, right? Because you have too much debt, right? And that way you have a solvency problem, because you might, if you have any kind of unexpected situation, you have a low ability to pay your debt, right? So that's we call solvency problem. And then the direct or related problem in solvency is that when you really find some interesting and profitable activities that you wanted to invest it, you are not able to do that anymore, right? Because all your cash flow has been committed to pay the debt, instead of you don't have any residuals to take advantage of any unexpected investment opportunities, right? So therefore, solvency problem is, first of all, is very risky, right? And then because you might have a bankruptcy because you fail to pay the debt, yeah. And the second thing is that you have very low flexibility because you cannot take advantage of good opportunities when it comes to your way because all your cash is tied up. And then there's a interesting thing that in this class that I would like to emphasize is the limitation of balance sheets. In other words, it's something that about accounting, this business tool that has drawbacks. First of all, a company's books value, asset equals asset minus liability, as shown in the balance sheet, right? So book value, right, means that how much the stockholder equity is worth is actually equals asset minus liability. Usually, it cannot directly tied to the company's market value. So how do we calculate in market value? We use the number of shares outstanding, number of shares of stocks outstanding, means that the shares that people are holding outside of the company, and multiple the stock price per share, right? So this is how market consider you how much this company worth, right? But comparing to the market value with the stockholder equity's book value, right? And the book value is actually equals asset minus liability. You will find usually the book value of stockholder equity is much smaller than the market value. If you calculate it, will be shares of outstanding and multiple stock price. So why is that? Okay, there's two primary reason that the balance sheet does not equal to the company's market value. The first reason is because many assets, as we know, are measured at the historical cost rather than the amount for which the asset could be sold, right? For example, if we bought a building, right, say in 2010, which is pretty, let's say 2008, at that time the real estate market is really crashed. So, and then 20 years later, almost like a decade later, same building, we bought at say 200,000, right, which is so cheap. But 10 years later, right, 10 years later, if you look at the same building, it probably worth 500,000 at least, right? So that means that, but on your book, the day you book this debit building and credit, let's say you paid by cash, right? So this building will park on your balance sheet forever at 200,000, and it will not be evaluated by using the market value because we never sold this building, we hold it. So this is one reason that possibly on the left-hand side of your balance sheet, the assets are pretty much stale, meaning that recorded at historical cost instead of market cost. Hence, this can cause the if you're calculating this SE stockholder equity, the asset is undervalued. Hence, that the book value of the equity is undervalued. Another reason is things that very interesting and important that I want to emphasize is kind of, I want to say, is a limitation of accounting, right? because many aspects of a company may represent valuable resources, but these items are not recorded as assets in the balance sheet and therefore have zero book value. For example, when you hire a CEO, right? The only places that I can think about the CEO's function in terms of financial statements will be in the income statement treated as a salary expenses, or stock compensation expenses, right? Stock option expenses, right? So that means that this financial statement is recorded at what is the cost of this person generating revenue for this company. However, there's multiple opportunities that I see a very successful CEO take, get a new job as the job hopping to another company that was in difficulties, and immediately, because this CEO switched the job, that company's stock went up really high, and then at that point that company's market value is definitely higher than the book value. So let's say just for example, hiring a very capable and high ability CEO, this person's potential and human capital is not able to using a debit and credit, say CEO HR capital, and then you book say $200 million or 2 million, right? Recognized as an asset and credit say cash or some sort of like a payable, right? We will not have this kind of journal ever recorded, but that's actually a very valuable transactions that not able to be taken care of by the accounting. Hence that it could cause asset are undervalued or liability is overvalued, and then therefore the stockholder equity is book value is very low. Okay, so I just want you to know that there's items that are not recorded as assets, okay, in the balance sheet are therefore zero book value, make the book value lower than the market value. And then, okay, let's look at the classification of elements with a balance sheet, within a balance sheet. The diagram here shows that the relationship between asset, liability, shareholder equity, right? So this is the like fundamental equation that we learned in financial accounting, and it often refers to as the accounting equation, and included in the illustration here are the sub-classification of each element. For example, the asset is breaking down by the liquidity of it, such as breaking down into current asset and long-term asset. And liability, we're breaking down into current liability and long-term liability. And the stockholder equity, we're breaking down by the source of the funding. One is a paid-in capital, which means external funding, and the return earning is internal funding. Okay, quick concept check. Which of the following is the sub-classification of asset in the balance sheet? A, cash and cash equivalent. No, this is account name, right? It's not subcategorized. Subcategorized is grouped by solvency or liquidity or source of the funding. B, revenue account name. Revenue is a income statement subcategory, and cash equivalent is assets subcategory. And then right now it's asking sub-classification of asset, so it should choose current asset. In other words, current asset and long-term asset is a subcategory of assets, right? And under here, current asset, you can have inventory, you can have cash, you can have accounts receivable, and long-term asset, you can have let's say equipment, PP&E, intangibles asset, so on and so forth, right? So disposable asset, and yeah, so C, right? Okay, So current assets, now we wanted to deep further in the current asset section, right? So what is a current asset? Current assets are those assets expected to be converted to cash or consumed within the coming year or within the normal operating cycle of business if that's longer than 1 year. So I want to emphasize so the concept of converting to cash, that's easy to understand. I wanted to emphasize the expected to be consumed within 1 year. So let's say first of all, let's look at that's the first understanding what is operating cycle. Operating cycle for a typical merchandising and a manufacturing company refers to the period of time from initial outlay of cash, means that you use cash to acquire something, and until right you collecting cash from the customer. So that's means cycle. For example, let's use the inventory as the example. I use cash to buy inventory, and I prepare inventory for sale, and I deliver inventory. Then I transform inventory to cash again because I collecting money from customer, and then I use whatever I collecting as a cash from a customer. I buy more inventory. So it's just gonna be on and on and on. It's called an operating cycle, right? How long took me to transfer a cash to cash, right? How long take me to converting cash to recipient of cash, outlay of cash to recipient of cash, right? So in some business, I wanted to emphasize here is that in some business, the business cycle is more than 1 year, right? So in this case, the current asset is not confined by only 1 year as a threshold. So usually we will use 1 year to judge whether this asset is a current asset not, right? So like this definition saying that the current asset are those assets expected to be converted to cash within the next coming year. So that means the 1 year is the threshold here. But there is the possibility that it take maybe 2 or 3 years for the outlay of cash become inflow of the cash for certain company. Let's say winery, right? If you wanted to produce wine and sell wine, right? And then that may take in 3 years to do that. So in this case, a lot of assets in this company is gonna be judged based on 3 years instead of 1 year as whether it's current asset. Or if you're a shipbuilder, right, the operating cycle is extending far beyond 1 year. And then sometimes it took 4 years to build an oil carrying super tank. Then the shipbuilder will classify those assets current based on the building cycle, right? But by most companies, 1 year should be the threshold, okay? And the elements of the current asset, okay? Normally, we would introduce you so following categories, right? First of all, there's a typical component including in the current asset is a cash and cash equivalent, and the short-term investment. And this one is not something that we emphasize in financial accounting, right? So we do emphasize in cash and cash equivalent. And accounts receivable, yes, we definitely talk a lot about it. And inventory, we talk decent amount of it. And prepaid expenses, we talk about it, but you might not realize how important that is, right? So therefore, let's go through one item at a time. So current asset of Nike, as you can see, this is laid out. They have a cash, they have short-term investment to some company, and then have accounts receivable is written in the net format, meaning that a collectible accounts receivable. So the gross accounts receivable already minus the bad debt expense estimates, right? So this is a collectible accounts receivable amount, and inventory and prepaid expenses and other current assets. So let's starting from the beginning, right? So start from cash and cash equivalent. So the most liquid asset, okay, in the current asset section is cash or cash equivalent. Cash including cash on the hand, like laying around in your company, or cash saved in the bank. And then it can also means bank drafts, cashier's check, money order, or cash equivalent. And what is the cash equivalent specifically meant? It means that the maturity date of that financial instrument is no longer than 3 months from the date of purchase. For example, it can be commercial paper, money market funds, and U.S. Treasury bills, right? So these items are listed as cash equivalent because they are highly liquid investment that can be quickly converted to cash with little risk to lose money, right? So basically, this three option is cash equivalent that you can almost use it as a cash. If you ever wanted to transfer it back, you can sell it with very little risk of losing its value, right? Okay. But I want to stress one thing. Okay. Cash that is restricted for special purpose and not available for current operation should not include in cash and cash equivalent elements, right? So in other words, if this cash is reserved for saying, for example, you are reserve this cash for paying the debt, right? Or you are restricting this cash can only spending on certain charity purpose. So this cash is not the cash that you can use, right? And then this kind of cash, when it's restricted for special purpose and not available for common use, currently operating, then this cash you should categorize on the long-term assets, okay, instead of short-term assets. Okay, next thing we want to introduce is a short-term investment. So investment not classified as cash equivalent that the company has ability and intent to sell, okay, within 1 year is considered short-term investment, okay. So this kind of investment can be stocks or debt security of other corporation, and the company has ability and intent to sell within 12 months or within the operating cycle is considered as a short-term investment. Short-term investment can be held to maturity or trading security or security available sale. This is three kinds, and this we will talk in details in the future. Okay, accounts receivable. I think we talk quite a lot in financial accounting. First of all, it's account receivable is a result from the sale of the goods and services on account, meaning that you already offered the services and you recognize the revenue, but you didn't collect cash, right? So you offered the services and the goods on account, waiting people to pay you back. That's why you have accounts receivable. or it's referred as trade receivable because it's highly associated with sales, right? And non-trade receivable can result from loans that you borrow to individual, such as your employee or your executive or other people. So, for example, you extending loan to your suppliers, say for $10,000, so that will be debit accounts receivable and credit in cash, right? So you borrow the money to them by charging the extra interest. So and then when they have an interest in, you can have an interest income and credits in interest revenue, interest receivable. Yeah. So this kind of journal will be done in financial accounting, meaning that non-trade related receivables generating from your loan to other people, right? This is also considered as the accounts receivable. And the accounts receivable usually has a life of 30 to 60 days, okay? And depending on the term offered to the customer, remember 1/10 and I think 2/30, right? So that means you got to pay in 30 days, and then it's take a 10% of with the pay within 2 days you can get a 10% of the discount. So anyway, so any receivable, regardless of the source, not expected to be collected within 1 year, is classified as long-term investment, right? So if you loan the money to someone else, so if you give someone a note payable, saying that you don't need to pay me until for 2 years, right? At that time, you pay me back for the principal and interest. So this kind of loan is not being considered as accounts receivable. It should be considered as long-term investment. In addition, accounts receivable is always reported in the net format, right? Because we wanted to assess how much how much the amount is not collectible. Hence, that the net accounts receivable equals the total receivable amount minus bad debt allowances, right? Or allowance for bad debt. Okay, inventory. So inventory usually have a 3 ingredient. It has a finished goods, working in process, and raw material. So this is a pretty straightforward, right? So for example, if you're Intel company, you will have products that has not even assembled, like plastics and components inside of the machine, and then you will have some materials already 60% done in the production line, and then also you have finished goods parked in the warehouse. Every form of this materials or product that you own are your asset. They can all be called your inventory. Okay. Okay, prepaid expenses is something that I want to talk about because my experience tell me students have a little bit hard time to understand what is a prepaid expenses, why it's a current asset. Okay, so first of all, prepaid expenses arises when the company incur a cost of acquiring asset in one period that won't be expensed until future periods, right? So, for example, suppliers, right, and prepaid rent, and insurance. And these assets are not converted to cash. Remember, current asset is assets that either can be converted into cash within coming operating cycle, right? So within 1 year, or is going to be expensed within 1 year. Right. So in other words, prepaid expenses it's not expense, although it's called expense, but it's not expense, it's a current asset, because these assets are not it's gonna be consumed in the future, and this future is within 1 year, right? So consumed, for example, supplies are used, prepaid rents are expiring over the rental period, and the prepaid insurance expiring over the period of insurance coverage. Whether a prepaid expense is current or not, right, it's all depending the period in which that this item is consumed. Say if your supplies can be consumed within 1 year, yes, supplies is current asset. But say your rent is being consumed in 3 years, so this prepaid rent is not being considered as a current asset, it should be long-term asset, right? Okay. Like insurance is covered for 5 years insurance, so that means this insurance is a long-term asset, right? Although it's a prepaid expenses. So it's all depending on how fast it's being consumed. Okay, let's look at the concept check here. Current asset including cash and all other assets expect to become cash or to be consumed within 1 year, within one operating cycle, within 1 year or one operating cycle, whichever is shorter, within 1 year or 1 year operating cycle, which one is longer? So D, right? Okay, now we're looking at the long-term asset. So long-term asset are the asset expected to be converted to cash or consumed more than one period, right? More than 1 year or one operating cycle. So it's it's opposite from the short-term asset, right? And the typical classification is, first of all, it can be considered as an investment, such as PP&E, right? It's a tangible asset, or it can be intangible assets. We call it and other long-term asset, right? So, like for example, Nike, it has these 4 elements here, right? First of all, property, plant, and equipment, identifiable intangible assets, and goodwill, and deferred income taxes and other assets. Consider the non-current section of Nike balance sheets from the year of May 2017, right, and May 2016. And we can see that long-term asset including all these elements. So first of all, let's look at the investments, right? Investments are assets that are used directly, are not used directly in the operation of the business. And this asset including investment in equity and the debt security of other corporation. So when you're investing in equity of other corporation, that means that you buy stocks of, say, Tesla, right? That means that you wanted to invest in Tesla because you think it's gonna make money in the future. Hence, that you are treating Tesla's stocks as a long-term investment in your balance sheet. The debt security means that you borrow money to, say, your peers or your supplies, right? So this is also considered as investment as well. Why is that? When you buy stocks of Tesla, you are looking for dividend, right, or premium in the stock price, right? And then you can cash out. But when you borrow money to your peers or your suppliers, that means you are make interest revenue, right? So both of this way is an asset, right, that can bring money or bring cash back to you, right? So as we defined here, asset expect to be converted to cash or consumed for more than 1 year, right? So the first one is investment. It means that the asset are expecting to convert into cash, right? If you invest in the stock equity or stocks from other company, you can converting this stock investment to cash. If you borrow money to someone, you can also expecting that debt investment to convert into money. And land held for speculation, same thing. Then you can sell this land in the future, right? And then converting into the cash longer than the current operating period. And then long-term receivables is almost similar as a debt, right? So you are waiting to collecting the receivables, converting the receivable to cash in the future period. And cash set aside for the special purpose that we talked a little bit earlier, that if the cash itself is not able to be used in the operating activities, right, cannot join the operating cycle, but set aside for a special purpose, that portion of cash is actually a long-term investment. Okay, and the PPE, namely, it's including tangible assets, right? It's long-lived asset. The assets are expected to convert into cash or consumed more than 1 year. So, also the most important thing about PP&E is that it's used in the operation of the business, right? So comparing to the investment are not used directly in the operation, but the PP&E are used in the operation of the business. It's reporting as a single amount in the balance sheet at the original cost minus the accumulated depreciation. So the PPE here including property, plant, and such as land, building, fixture, equipment, machinery, furniture, vehicles, as well as natural resources, mines and timber and oil wells. Remember that land often is listed as a separate item in the classification because land does not have a finite life, right? It does not depreciate. Okay, intangible asset. Intangible asset is generally representing exclusive right to use something, right? It's a very valuable resource in generating future revenue. For example, patent, copyright, franchise, and trademarks are able to, for example, you purchased copyright from someone or trademark from someone, you can use that to exclusive to produce certain product or process or name, and then can transfer those to be a valuable resource to generating revenue in the future, right? And then they report in the balance sheet, and then they report a net of accumulated amortization. And then it can be either purchased or developed internally. And I want to say that not all the intangible assets are purchased, right? Sometimes the company develops itself, right? And for especially pharmaceutical company, right? And then they develop some certain pills and vaccines, and they investing a lot of research and development into the product stage, and then they establish their patent, and then that patent itself is developed internally, right? So therefore, that can also be considered as intangible assets. What about the goodwill, right? So we talk about goodwill a lot. And I want to say that goodwill is not associated with any specific identifiable right. Goodwill, it cannot specifically use it to do something, but instead it arises when company acquire another company by paying amount higher than the book value. So basically, if you are a buyer, right, you paid say $1 million to buy company B, right? And company B only was 500,000, so that means you will have a goodwill of $500,000 on Bank of A's book, on the A's balance sheet, and then we call it a goodwill of company B. So this goodwill not necessarily gonna transfer to cash as other those exclusive use rights, but instead it will be very important assets that shows that your company is actually worth more than what it was the acquired company actually was on the book value, right? So you purchased something much higher than the book value of something, and then the extra purchase, the value is parked under the goodwill. And the other long-term assets, what it means that it means that the balance sheet often including a catch-all classification of long-term asset called other long-term assets, right? And these are including the items were not reported separately in one or the other long-term classification. It's often including the long-term prepaid expenses, or might also including long-term investment not material in amount. And a key to understanding in which category an asset is reported is management intent. This is very important. So in other words, whether it's a current asset, long-term asset, other long-term asset, it's all based on the management discretion. Okay, so for example, management may intend to use land for long-term operating purpose, right? So therefore, if you are using the land for operating purpose, then that land will be belong to property and property, plant, and equipment. But if you say that you wanted to use it for future sale, so if the land is used in operating activity, then this land is a part of a product, plant, and equity. But if it is used for future resale, that means this land is an investment, right? If you wanted to use to sell in the ordinary course of business, means that your business is trying to sell land, then this land is an inventory, right? So therefore you can see that same land, based on the management discretion and intention, it can be categorized as a PPE, or it can be categorized as an investment, or it can be categorized as inventory. So it depends on the essence of the business and the intention of the management. Okay, so following. Which of the following is most likely to be recorded as a long-term asset? Right? B, right? Building. Which of the following represent tangible, long-lived asset used in the operation of a business, right? So this one, property, plant, and equipment. The reason is that the current assets are not long-lived investment, not long-lived, and investment are not used directly in the operation, right? So this is a keyword here, is directly used in the operation. And the intangible asset has no physical substance, and because it says intangible, right? So therefore we choose C. Okay. Next thing we're going to talk about is a liability. Liability representing the obligation to other entity, right? So that, for example, it including by classifying them as the current liability, long-term liability. So the liability section of the Nike Inc. The balance sheet is shown above, and the Nike is accrued liability, including accrued compensation. So this one is important. It can be include accrued compensation to the worker. And what does that mean? It means that the expenses that incurred that you have not paid for it, right? Or the taxes that incurred that you have not paid for it. And the company classifies the current portion of long-term debt as short-term debt or current debt, right? Okay, current liability stands for the obligation that are expected to be satisfied through the use of current asset or creation of other current liabilities. So in other words, this classification including all liability that are expected to be satisfied within 1 year from the balance sheet date, right? Or within the operating cycle, which one is longer. And there's an exception for the current liability classification is the liability that management intends to refinance a long-term basis debt. For example, if a manager is intended to refinancing a 6-month loan, okay, which is smaller than 1 year, so that way you thought that 6-month loan is actually short-term debt or current liability. But if the intention is always refinancing this 6-month loan using a 2-year-old loan, right? So that means this 6 months loan is not a long-term asset. It should be categorized as a long-term asset, right? So the most common current liability, including accounts payable, notes payable, and deferred revenue, accrued liability, and current maturing portion of a long-term debt. Okay, so before I go into further about the current liability, I wanted to creating another video for this because I wanted to introduce step by step. We'll look at finished asset, we'll look at liability, and next we're gonna look at the equity. And after that, we're gonna look at how to presenting financial statements. So I will see you in the next video.